All right. And we are live, y'all. Thank you guys so much for joining us. I just want to make sure that we're extending our Movement Mondays and bringing in guest speakers on different topics. I am not a master of all. I am familiar with quite a few loans out there, but there are people that just focus specifically on certain products. And Dan has been doing reverse for quite some time. HECMs, to be more precise nowadays, we're calling them HECMs or reverse mortgages, whatever. They're interchangeable, y'all. But I wanted to introduce you to Dan. He's our national director of reverse mortgage communications, and he knows reverses like the back of his hand. And literally, like, I have completely changed my entire opinion about reverse mortgages after listening to him. So I wanted to bring him directly to you and help us all get a little bit smarter and a little bit better at our job. So without further ado, Mr. Dan Hultquist, thank you so much for being
Thanks,
here.
Eddie. Yeah, a pleasure to be here. And you guys are in one of my favorite markets. I love the San Diego area. I've spent a lot of time out there teaching a lot of reverse mortgage classes. I've been doing this for, maybe 15 years now. And so about 10 years ago, I wrote a book that's done really well. It's been republished every year since then, called Understanding Reverse. And so I get asked to speak a lot about this product. But one of the things I'm passionate about is working with the real estate community, because there's a lot that everybody can gain from this. Obviously, we would like to do more mortgages. You'd like to get more listings, more sales, and increase your borrower's purchasing power. And we can do that as long as they're 62 and older, right? So let's take a look at, this is a presentation that I put together called Retirement Mastery for Real Estate Professionals. And there's a lot of misunderstandings about the product. Hopefully we'll clarify some of that. But very little is known about how what we do in the reverse mortgage community blends in with retirement planning and real estate and housing wealth. And so hopefully I can shed some light on some of those concepts today. But you really have a lot to gain as a real estate professional by understanding just a little bit about what we do. So let's go ahead and get started. Now, sometimes when I start talking about retirement and housing wealth, I use this little 3-bucket diagram, and it's really not that hard. We make a bunch of money during pre-retirement years, and some of it goes right back in here into bucket number 1. That is your future income. That would be Social Security, right? We put money in, and ultimately we have a bucket number 1 that represents future income for us in retirement. Now, if we're good boys and girls, we're going to put some money in here into bucket number 2, which is your traditional nest egg. That's your IRA, life insurance policies, 401k, stocks, bonds, and things like that. But because of us, the mortgage community, the real estate community, our clients put a lot of money into bucket number 3. It's not just their monthly payments, it's down payments, maintenance and utilities and upgrades and add-ons and all the things that we do to maintain our home. We put a lot of money into bucket number 3 during our working years. And yet when we get to retirement, everybody blocks off bucket number 3 and says, you have this massive source of wealth and cash flow, tax-free cash flow, sitting right here in bucket number 3, and it's off limits. Well, we put it there, right? We encourage people to buy homes. You sold them the home, we financed the home, and they built up this, what should be generational wealth. And they think, well, I'm going to pass that on to my kids free and clear, without realizing there are more efficient ways to pass on wealth through your IRAs, your 401ks, stocks, bonds, and life insurance. There are all kinds of ways that you can pass on wealth either while you're alive or after your death, other than a paid off free and clear home that is very useful for retirement planning. So let me give you a couple of illustrations, show you what I'm talking about. Most people, when they turn 62 to 63, they will file for Social Security. Is that optimal? No, not even close. All right, they should not. There are a few people that should, but the majority of Americans should not file for Social Security between age 62 and 63, but more than half of them do. The reason they do that is because For some reason, they want to keep putting money into bucket number 3. When you're 62, you don't have to. So a lot of people don't have an efficient retirement because they file too early on Social Security. And when that's not enough, they start drawing from their IRA and 401k and stocks and bonds, selling even during a down market. And ultimately, it's a very inefficient retirement because they blocked off bucket number 3. Now, a lot of people think what we do is we keep people in their homes. It's not necessarily true. We keep people in the right home. If it's not the right home, we want to work with our real estate partners to make sure that they are in the right home, the kind of home that allows them to age in place. But we advocate for using a combination of bucket 1, 2, and 3 as a retirement strategy to increase your cash flow, increase your liquidity, reduce your tax liability, and we can show you how you can have higher net worth if you use 3 buckets instead of only 1 or 2. So that's kind of an introduction to how we view retirement. The way you create liquidity from bucket number 3 is with a tool called a reverse mortgage. So I'm going to make sure we have kind of a fundamental knowledge of what is a reverse mortgage. And then we're going to talk about the HECM for purchase, where you can buy a home with a reverse mortgage. So this is a basic definition of a reverse mortgage. It's any loan or lien secured by a home where repayment is simply deferred into the future, which is a beautiful thing, right? Deferment is a lot better than forbearance because this is permanent. It's deferred into the future and it's not repaid until the home sells. Now, there's all kinds of reverse mortgage products out there, but the vast majority in America are the home equity conversion mortgage. That's the only federally insured reverse mortgage in America. It has an age requirement. You do have to be 62 and older. If you're married to someone under 62, that's great. We protect them too. Since 2014, we actually protect non-borrowing spouses. And so there's a complex set of rules around that. But ultimately, if you're a 62-year-old married to a 50-year-old, the 50-year-old can stay in the home until another maturity event occurs, if the 62-year-old were to predecease the 50-year-old. Now, what does this product allow people to do? Convert a percentage of their home's value into cash. Or what we like to see people do is leave the unused portion of your reverse mortgage in a growing line of credit. It grows at the same rate as your loan balance. Some people borrow a lot of money over here and they have very little in their line of credit. Their loan balance is growing at the interest plus 0.5%. Some of our borrowers borrow very little and they have a massive line of credit. Well, the line of credit is growing at the same rate that the loan balance would, the interest rate plus 0.5%. And that is the home equity conversion mortgage. It allows you to continue to own and live in your home. Yes, you still retain title and ownership of your home, but you do have to occupy it and pay all your property charges. Nice thing about the HECM, it does not require a monthly principal and interest mortgage payment for as long as the loan is in good standing. And that's what makes it attractive for someone who maybe owns their home free and clear. But there's also a way that you can buy a home with a reverse mortgage. And we're going to get to that here shortly. Some of the misconceptions, I'm just going to go through this rather quickly. No, the bank doesn't take the home. That's not the way it works. The bank does not get your home at closing, and it does not get the home when you die. You can pass it on to your heirs. They can sell it and receive the difference. And if you're upside down, no worries. The heirs will not be responsible for the debt. It's a non-recourse loan. No, it's not a last resort option. I'm going to get one when I turn 62, and I'm the top selling author on the topic. So if I'm getting it, and my national director, who is also an author on reverse mortgages, he got one the day after he turned 62. Neither of us are using it because we're desperate. I won't need one, but I'll want one. There's a big difference, right? Because of the flexibility it provides me, especially for the real estate community. Okay, you know your income does this, right? It goes up, it goes down, it's kind of seasonal, and sometimes you have good years and bad years. Wouldn't it be nice to have an optional payment? And then you make a payment whenever you want to. You have a good year, make sure you can pay down your loan balance if you want, and your line of credit will grow dollar for dollar. Yeah, the heirs are not responsible for being upside down on the loan. It's called a non-recourse loan, and by the way, that's federal law. There are federal statutes. If you are going to sell any type of reverse mortgage in America, it has to be non-recourse, which means neither the borrower nor their estate will ever owe more than the home is worth at the time it's sold. Now, how can they do that? FHA insurance. FHA's got your back. People complain that there's an insurance premium associated with it, mortgage insurance, but that's actually for the borrower's benefit. They can borrow up to their limit, and if property values drop, they're protected. Now, FHA in some years takes a very large loss on these loans. So that's why we do allow, why you can never owe more than the home is worth. And by the way, that's point number 3 here. Heirs get stuck with a bill? No, that's a myth. The heirs cannot be held liable for the debt. FHA pays the difference if they're upside down. Yeah, what happens to the existing line of credit that someone took after they pass away? If the last borrower dies, the line of credit goes away because it is credit. It is a form of credit. It's not an asset. If it would be taxable, right? But it is pledged funds to the borrower and the borrower only. And by the way, non-borrowing spouses can't borrow from that either. So do we have people borrow every penny from their line of credit on their deathbed? Yeah, it happens. The FHA was very concerned about that at one point, and they called it the ruthless option, where if someone has a line of credit worth more than their home, they would actually draw every penny from the line of credit. And they ultimately decided it will be highly unlikely, and FHA has the wherewithal to pay any claims for that. Yeah, good question, Eddie. Can you outlive a HECM? No, the default maturity date is age 150. Now, we reached out to HUD several years ago and said, what if someone were to live that long sometime in the future? And they said, well, then we would actually extend the security instrument. We would actually have them update a security instrument to a longer term. And so now we can say, yeah, HUD guarantees you cannot outlive it, which cannot be said for a HELOC, can it? Any of you lose your HELOC in 2008 like I did? Yeah, I got the phone call from Chase and the letter on the same day. It was like, it came next day, the next day error. And I was like, looking at the letter, I'm like, I just got this HELOC. Okay, so HELOCs can be taken away. Obviously, they have terms anyway, but age 150, you're going to have access to that money. And then lastly, are they expensive? Well, it kind of depends on how you use it. There are fees associated with a reverse mortgage, but I would consider it very inexpensive when you consider what you're getting. Remember, price is what you pay and value is what you get. Warren Buffett taught us that. A price is what you pay and value is what you get. What's the value of a reverse mortgage? A non-recourse loan at extremely competitive interest rates that doesn't require a monthly principal and interest mortgage payment until in some cases a year after you're dead. That's a very valuable product that I want, right, when I turn 62. Okay, so just cruising through these slides, I want to mention this because a lot of people believe that addressing an urgent need is the only way to use a reverse mortgage. And when I got into the industry, that was my dominant client. They're facing foreclosure or bankruptcy and they're panicking and they're like, I'm house rich and cash poor and I need money now. Can you pay off my existing mortgage and give me cash? And yeah, we can do that. It's one of the great things about the product, but that's actually a really small piece of the pie. We don't actually do a lot of that anymore, right? What we do is we help people enhance their lifestyle. So Mrs. Smith wants a new kitchen. Okay, well, she doesn't want to take money from her retirement savings to do that. We'll let the house pay for it. And so we'll leverage some of her housing wealth to update the kitchen or the bathroom to meet her physical limitations. Or she wants to buy a new car. Or she wants to travel to see the kids and grandkids. Or in some cases, travel to get away from the kids and grandkids. We see that too. Put me on a cruise and get me away. I don't want to do any more babysitting, right? And so we do a lot of lifestyle enhancement that just allows somebody to go out to dinner every once in a while or get their country club membership back. Let the house pay for some of that so that you don't have the tax hit of drawing that money and ruining your retirement plan.
I mean,
But
at the
what?
end of the day, it frees up a ton of cash flow, right? You don't
Oh,
have that
sure.
principal and interest payment. So, and especially when you're on a fixed income, when you stop working and you don't have much else coming in, right? That's a huge
Yeah.
advantage.
Yeah, and your financial planner, getting to point number 3, your financial planner says, Mrs. Smith, you're going to run out of money by age 84. Oh, really? She has $1 million house paid off free and clear. Why aren't you considering bucket number 3? Leverage some of that and manage your adjusted gross income and all the other things that you can do with that extra liquidity. Sometimes we work with CPAs and we look at your adjusted gross income and say, you're projected to draw this much from your retirement planning this year. Draw this much and draw the rest tax-free from a line of credit so that you stay under a tax threshold. There's all kinds of little tricks that we can use, these tips and tricks to help you have a more efficient retirement. You're going to run out of money at age 84, and we can show you that you're going to run out of money by age 105. Well, that's quite different, right? Just by managing where you draw your retirement cash flow and when. You do not want to draw money from a 401k or IRA when the market's down. We were taught to buy low and sell high, right? Don't sell your stocks when they're low. And so we can manage all kinds of things with the help of your financial planner and CPA. But we're talking to realtors today. You can buy a home with a HECM in 2 different ways. And we help realtors and their clients all the time to do 2 different types of purchases. One, you get a reverse mortgage on your existing home to buy a second home or investment property. We see it all the time. Okay, that's a great option. You get a reverse mortgage. You don't have to liquidate your retirement savings to accomplish this, but maybe someone wants to buy a second home. Well, they can do that by getting a reverse mortgage. The second way you can do buy a home is selling your existing home and use what's called a HECM for purchase to buy your next principal residence. Okay, in this case, you've got to be buying your principal residence, which is where HUD defines your permanent place of abode, where you typically spend the majority of the calendar year. Okay, so there's 2 different ways you can buy a home. The HECM for purchase is a very underutilized plan. I was planning on doing this at age 62. Now, I've got to move back to Pennsylvania to help take care of my aging parents. And so my plans actually changed, but I was planning on moving at age 62 and buying a home with a reverse mortgage, knowing that any debt that I have at that point is acquisition indebtedness, which the IRS considers to be deductible. So that's probably more than you wanted to know on that one. So let's talk a little bit more about the HECM for purchase. Traditional financing generally doesn't work for older homeowners. First of all, they'd have to qualify for that traditional financing, and with their income, sometimes it leaves very limited options for financing. But consider that before this product was available, people would have to buy their home in cash or with traditional financing. They'd have to season their residency for a year and then get a reverse mortgage a year later and pay all the same fees. HUD just combined them into one transaction and said, we will allow you to buy a new home and use any proceeds that the lender could offer you based on the sales price of the home. Okay, it's the lesser of the sales price or the appraised value. So if we're looking at a $1 million property, can we throw $400,000 towards the sales price? And they only have to come to closing with $600,000 and still have no monthly principal and interest mortgage payment? Yeah, we can do that. So traditional financing generally doesn't work. And so, but this is also really very important to you as a real estate professional, because we can show you how you can increase your listings, increase your sales, and increase your purchasing power at a time when there's not a lot of supply on the market, right? We historically see somebody who nets $500,000 on the sale of their existing property, or that's what they're projecting. I'm going to net $500,000. My uncle is a perfect example. He's selling his home in Florida right now, and he will net $500,000. He's looking at another place to buy, and he says, well, I don't really want to spend all my $500,000 on this next home. How about if I have the HECM product, finance 40% of it, and I'll come to closing with 60. Or maybe you're like some of our clients, they look at the 500,000 in the area they want to buy. There's nothing for 500,000. So can they buy an $800,000 home and still get what they want, which is no monthly principal and interest mortgage payment? Yeah, absolutely. So there's all kinds of strategies for using the HECM for purchase to help build your business at a time when maybe prices are high, right? And people have limited options, and so they want to buy. So typical eligible property types for an FHA loan. And by the way, this is an FHA insured loan. It is not an FHA loan. Let me make sure I calm your fears, because a lot of agents think, oh, no, it's an FHA loan, right? It's an FHA insured loan, but we close these things in 17 calendar days. That's unheard of in the reverse mortgage space. Well, how can we do that? We have the best operations team in the business. It's not even close. 17 calendar days on a HECM for purchase when the rest of the industry is at 60 to 90 days. Do you want to wait 60 to 90 days? No. Okay, but we can do it very quickly. Just keep in mind, this is FHA insured, not an FHA loan. Single family residence. I just want to point out one thing right here about 2 to 4 unit properties. We have clients that buy a quadplex in retirement, occupy 1 unit, and rent out the other 3. Amazing. It is such a great option. Now, I don't know the market out there, whether there are duplex, triplex, and quadplexes. If there are, phenomenal retirement strategy for someone who can use the reverse mortgage for the entire property, only occupy 1 unit, and rent out the other 3 for cash flow. So beautiful strategy for retirement. Typical property types for FHA. Now, what are the motivations? Why are people doing this? Some people want to relocate now that they're not tied to their workplace. They want to be closer to the kids or grandkids. Maybe they want to move to another geographic area. Maybe they want to move to San Diego because the weather is like room temperature year round, and I love it there. There's so much to do and great restaurants, and I love the ocean. I love the SeaWorld and then the zoo. I would consider relocating if I didn't have to be in Pennsylvania, right? I would love to be in San Diego. So that's one motivation. The next is what we call right sizing. Hey, great question, Eddie. The HECM limit right now is $1,089,300. So that would be equivalent to the high cost limit, right? So it's typically 150% of the conforming limit. And so, but it's a flat nationwide. So flat $1,089,300 for this calendar year. We'll see if it goes up a little bit for 2024, but usually they tell us at the beginning of December, after the Thanksgiving FHFA report comes out about home value appreciation. And then the FHA will decide for HECMs whether they want to follow the lead and go to 150% of the conforming limit. Great question. So we call it right sizing. Some people call it downsizing, and then some people felt that downsizing was demeaning. I don't see it that way, but if you want to use the term right sizing, this is for someone who maybe is in a 2-story home with a full basement on a couple acres, a lot of maintenance, and they've had a hip surgery. A widow with a hip surgery, hip replacement, doesn't need to be going up and down stairs. So owner's suite on the main, ranch style home, maybe a townhome, maybe a condo, something a little smaller with less maintenance would be an example of right sizing to a home that meets their needs. Upsizing is generally what my clients did. They want to be at the beach, the golf course, the lake, the active adult communities. Those things are spectacular. I just want to go to the active adult communities so I can play more pickleball and go to casino night. Right? That's awesome. Great amenities, but they can be expensive. So the HECM for purchase allows people to get in those homes and not use all their cash to do it. And then last, divorce. Silver divorce, gray divorce, boomer divorce, whatever you want to call it, is on the rise. The trend is like straight up. And so I know in California that's the case. Throughout the country, we've seen it double over the last 10 years. But divorce is devastating to people from a retirement planning standpoint. What we can do is lessen the damage that is done. There's two strategies. One is they sell the marital asset, which is great for you because you're going to get that listing, and then you're going to get 2 sales. You can get 3 transactions if you work with some of our divorcees, our divorce clients. We work with divorce mediators and family law attorneys. And if their decision is, this was our house, we are going to split up the equity in 2 different directions, you could get 3 transactions. And we've seen it happen repeatedly. Now, the more common strategy for divorce is one homeowner says, nope, this is my house, I'm keeping it. But they have to pay off a departing spouse. Well, how are they going to do that? Obviously, you're not going to get a listing on the borrower that wants to retain the home, but we can do a reverse mortgage on the existing property to help the departing spouse, give money to the departing spouse, and they can use a HECM for purchase to buy their next property. That way, neither has to liquidate all of their retirement savings to make a divorce work. So great strategy. 1, you split the marital asset. 2, you can do a spousal buyout. And spousal buyouts could be very good for you in that you're going to get that transaction on the sale of the next property. All right, just moving on, just some fundamentals. It does require an FHA appraisal, but again, not an FHA loan. It's going to use the lesser of the appraised value, the sales price, or the HECM limit, which is $1,089,000 this year. Credit score, don't care. Doesn't matter. We do not even look at the credit score, but we do look at some of their credit history and property charge payment history. Those are very important. They do have to plan on moving in within 60 days. We do need that original purchase contracted application with all the amendments. So just bear with us. We actually have to have that at the time of application. And we do new construction, and we do new construction very well. So we can work with your builders, especially builders in 55 and over communities. We love working with them on these loans. All right, so this is just an estimate. If you're 62, you're not going to get as much money because of longevity, right? They use actuarial tables for life expectancy. And so a 62-year-old is not going to get as much, whereas maybe an 82-year-old is going to get more than half. We can contribute more than half of the sales price, yeah, for older borrowers. Now, unfortunately, we see the hot zone for people to use the HECM for purchase is between 62 and 70. All right. So right now, because interest rates are high, you're getting less money. When interest rates drop, you can get more money with a reverse mortgage. But, you know, my uncle said it best. He said, well, I was planning on buying the home in Oklahoma in cash. So any dollar I don't have to pay is found money. And so he's going to use the rest for upgrades and add-ons and renovations and retirement cash flow, right? It's more liquidity for him. He's like, yeah, I'm all in. Now, he actually is in his late 70s, but yeah, he's going to get close to 50%. Just know that as you get closer to that 62 range, or if they have a spouse under 62, that is going to limit the amount of money we can apply. But again, if I told you we had this great loan product that requires a 60% down payment, you'd laugh at me, right? But we're comparing it to cash transactions. And we can close as fast as a cash transaction. So, but this is not a first-time home buyer product. This is for someone selling a home, relocating, and buying another home. And so coming up with 50, 60% is usually not an issue.
Hey, Dan.
Yeah.
Can I interrupt you real quick? I'm really sorry. Can I double down on that loan limit question and ask you, would the multi-unit, will that same FHA loan limits pertain to the multi-units as well? So you're talking like for a 4-family, almost 1.9 million is what the loan amount would be for a HECM?
Yeah, it's one national limit nationwide for all property types.
For all property types. Okay. So
Yeah.
it doesn't have the 2-unit, 3-unit, 4-unit division. Okay. Understood. Thank you.
Yeah, and it actually goes back to the Housing and Economic Recovery Act of 2008. They said, let's just standardize it for reverse mortgages. It's going to be that, you know, back then it was what, 417,
Yeah.
and went up to 625.5. And it's ever since it went to 625.5, it's been going up since then.
Gotcha. Thank you.
And you know what? That's actually controversial at HUD. HUD feels that maybe HUD and FHA feel that maybe it's pushed beyond the where they want the market to be for reverse mortgages. And we pushed back and said, no, that's not what the reverse mortgage is. See, they have the same misunderstandings. This is not for desperate, needy homeowners. This is for people in San Diego. This is for people in Southern California. California should be using the reverse mortgage product. It's outstanding for them. So yeah, we pushed back and they said, okay, we understand.
Yeah, I think Ashley put out a stat during the last stat meeting that there was like 287,000 homes in San Diego County without a mortgage. And
Yeah, that's amazing.
I need to find those people.
And you know what? Let me go back to the previous slide. That is the limit for the HECM product. That is not the highest values will go, because we have proprietary reverse mortgages. 70% of all the proprietary reverse mortgages in America right now are sold in California. We can go up to 20 million. So I think the record I've seen is 14 million on property value. Now, as a percentage, you're getting a little bit less, but once you get to about 1.5, 1.6 million, the proprietaries offer you more money. They offer less as a percentage of the home's value. But when you have a $20 million property and you can give them, 35%, that's amazing. So yeah, just know that we do have access to 3 different proprietary, I guess 4, two investors and 2 products each. So we have 4 proprietary products that we can use in California right now.
That's awesome.
Yeah, good question.
Thank you.
Good comment. So that was your illustration showing that older borrowers generally qualify for more money. By the way, it maxes out at about 72, 73% right now for our oldest borrowers. So I created this slide 10 years ago when this was a typical example for us. You haven't seen property values like that in years in California, right? So just bear with me because the infographic hasn't changed. But back then, we would see someone gain $300,000 on the sale of their property and they'd turn around and buy a $400,000 home and only use $200,000 from the sale and leave $100,000 in cash for whatever purposes they wanted. That was typical. Now our average home value is well over 500. Okay, but this was a downsizing example. Same borrower nets 300,000 on the gain on their sale, but they want to downsize to a 200. Well, then that leaves them $200,000 in cash remaining they can use for retirement savings. For someone in this scenario, having an extra $200,000 in cash is huge. That gives them the ability to optimize their retirement planning with life insurance policies and things like that. So that's game changing for a client to downsize. So where can you learn a little bit more about this product? I wrote Understanding Reverse again 10 years ago. It's been the top selling book for about since it came out. It comes out every year because this product changes. A lot of the changes occur on October 1st each year, which is HUD's fiscal year begins on October 1st. And then some of them become effective for the new year, which would be January 1st. So every year between October 1st and January 1st, I work with our regulators and some of our investors to make sure the book is updated to reflect current law. And so HUD buys the book for me, FHA buys the book for me, consumers buy it, lenders buy it because they use it for training purposes. If you want more information about how the product works, Understanding Reverse is probably your go-to guide. It's very simple in the way it's written, and all the regulatory references are in the back. Now, my director is Harlan Akula. He's the National Director for Reverse Mortgages here at Movement Mortgage. He wrote another book that is completely different. And when he wrote his book, I was able to read the manuscript before it came out. And I said, there's no overlap between your book and mine because you don't tell how it works. You tell people why they should do it. which is the strategic use of home equity and retirement, and how the product can be used to make a better life, living your best life now. And so his is really the psychology behind it and making a case for why people should do it. And he believes 95% of America should do this when they qualify for it, usually when they turn 62. I would agree. So Harlan's book is more persuasive. It's more, goes into financial planning and the use of the product. So those are some options for you. Both are available on Amazon. And so I just wanted to open it up for some questions. I know this can help you generate more business. And we have a supply issue. And I know we have a big supply issue. And congratulations, someone at the beginning of the call mentioned about a listing or a sale. There are not a lot of listings in America right now, right? So only about 600,000 listings in America. Well, this is a way to create more listings. People don't relocate because they don't think they can. They look at their financial situation and say, how would I ever do that? I feel like I want to be closer to the kids and grandkids, but I can't afford it. Or I'd have to drain my retirement savings. And they don't have to. And as we get this message out, you're going to find we will have more listings, we will have more sales, and we will help people increase their purchasing power with this one outstanding product. Does anybody have any questions?
Don't be shy, you guys.
I'm sorry?
Raise your hand.
Oh, okay. Yeah, Tracy said, fly, Eagles, fly. I'm going to be in central Pennsylvania at Penn State University. I grew up actually in that area. And I'll tell you, there are a lot of Eagles fans, but there are also a lot of Steelers fans and Giants fans. And now, yeah.
Well, I had to shoot my shot.
Yeah, but you know what? Some people in Pennsylvania consider that more like West New Jersey. But I love the Philly area for one reason and one reason only. I have never had a good cheesesteak in the Atlanta area in the 30 years I've lived in Georgia. And so I'm anxious to get back to Philly because the cheesesteaks are phenomenal there. Yeah, go Nittany Lions. We're, I think, 7th right now. So I will be a season ticket holder next year.
I do have one question. I know this is being recorded. Is this going to be shared with us after the recording?
On my YouTube channel.
Thanks, Eddie.
Yeah, you bet. Absolutely.
That's
It'll be
awesome.
right away.
This was such amazing information. And I have always, like Eddie said at the beginning of the call, I've always thought that reverse mortgages were negative. And this information was really positive.
Thanks, Tracy. And you know what? I was in that camp too. I was in the mortgage industry long before I ever discovered the value of this product. And I'll tell you a little story about how it happened, because I steered people away from it. And they would say, well, why wouldn't I get a reverse mortgage? And I said, because it smells bad, right? Something about this that doesn't click with me. I'm confused by it. And if it's that confusing, then you know what? You need to find another source of financing. And I feel ashamed at this point that I thought that, but I didn't know why I didn't like it. It just didn't sound right to me. There's got to be a catch. Until the housing crisis. And I don't know what you guys did when, for me, my realtors weren't selling, my builders weren't building. And I said, honey, I'll take the kids during the day and I'm going to go downtown Atlanta and help people in need. And so I went downtown Atlanta and I was a housing counselor because I knew the products. I sold them the products, right? So I knew how to modify these loans. And so I was a housing counselor for 14 months during the housing crash. And during that time, I was very frustrated with the national lenders. I was like, this guy on Long Island only owes $9,000 on his mortgage and is, 2 years of back taxes in Long Island. The house must have been worth more than $1 million. How is no one willing to modify this loan? And I just yelled out one night, how the heck can I not help this guy? And a guy down the hall said, what age is he? I said, what the heck does that matter? And he said, no, how old is he? And I said, it's a 65-year-old veteran who's going to lose his home. And he said, patch him through. I'll talk to him about doing HECM counseling instead of housing counseling. And I went into his office and watched the conversation. A few weeks later, we had paid off his $9,000, paid off, worked with the lender to pay off his back property taxes, gave him a chunk of money to pay off all of his unsecured debt, and left him with a line of credit that's growing at the same interest rate as his loan balance. And I'm thinking, this guy's life just changed. It was life-changing for me to watch it happen. And I was like, I'm a big fan of this. Why does everybody not know this? And that's when I started to write the book, Understanding Reverse. And then ultimately was able to publish it in 2014, I believe.
Honestly, after hearing you speak and Harlan speak, I am 47 years old, bought our house that we live in now 4 years ago, and thinking to myself, man, I got a 30-year mortgage on this thing. I'm going to be 77 years old, and I got a 2 and a 4-year-old, right? So I'm like, oh my God, this is going to be crazy. They're going to be in college. I'm going to have to pay for this house. I'm going to have to pay for college. But then come to realize when I hit 62, I can stop paying for the house and I'll have a line of credit and I'll have college paid for. Like this light bulb went off in my head. And I'm just like, oh my God, I need to like start spreading the word. And I'm so thankful that you guys have joined Movement Mortgage. It is awesome to have your team here and you and everybody else, man. Thank you so much.
Well, thank you for that, Eddie. I'm 54, and technically, if I used a proprietary, I could qualify next year.
Oh, wow.
I will probably wait. I don't need one at this point, but I will probably wait until I'm 62 and get a HECM.
Yeah, it's going to help a lot with the financial planning with 2 toddlers, that's for sure, at my age. Birdie. Right around the corner, buddy. You blink, it'll be there. Well, thank you so much, Dan. If nobody else has any questions, I know, Dan, everybody's time is very, very valuable, and it's the beginning of a long week. So I just want to thank all of you guys for joining us today. Dan, thank you so much for coming on board and educating all of us, man. You're always such a wealth of knowledge, and it's so amazing to have you on the team.
I love it. Thanks for the invite.
Yeah, absolutely. Thank you guys for coming, and have an awesome week, y'all. See y'all soon.
Thank you.